Behind every expert advisor lies a trading strategy, and understanding those foundations is non-negotiable. An EA is only as good as the logic it follows, so knowing the strengths and weaknesses of different approaches is critical before you ever write a line of code. Some strategies are designed to ride trends, others to capture tiny market fluctuations, and some thrive in sideways conditions. Each comes with its own risk profile and ideal market environment. When matched correctly, they form a solid base for automation. In this lesson, we'll explore the most common strategies used in EAs, what makes them work, where they shine, and how to choose the right one for your goals and risk appetite. Trend-following strategies are the backbone of algorithmic trading. They operate on the simple principle that once price begins moving strongly in one direction, it's more likely to continue than to reverse. The old saying, "the trend is your friend," exists for a reason. In practice, these strategies rely on tools like moving averages, breakouts, or momentum indicators. For example, when a faster moving average crosses above a slower one, it signals potential upward momentum. An EA can instantly trigger a buy. Similarly, when prices break through established highs or lows, the system can act to capture the move. The trade-off is that trend-following systems usually have lower win rates. They'll take several small losses when markets chop sideways. But when a true trend emerges, the gains are significantly larger, often dwarfing the losses. With sound risk management, this asymmetry creates a favorable edge. These strategies perform best in trending markets, and when managed carefully, carry moderate to low risk. This balance of simplicity and reliability is why so many EAs are built on trend-following foundations. If trend following is about riding waves, scalping is about skimming the surface for quick wins. Scalping strategies aim to profit from tiny price movements, sometimes just 1 to 5 pips, executed within seconds or minutes. An effective scalping EA can place dozens or even hundreds of trades in a single day. These systems rely on tight stop losses and depend on extremely fast execution, which is why they thrive in high liquidity sessions like the London and New York overlaps. Because price slippage and spreads directly impact profitability, scalping requires brokers with strong execution speed and low transaction costs. The appeal of scalping is its high win rate, often between 60–80%. But the flip side is risk. A few bad trades or one major slippage event can wipe out the gains from dozens of small winners. This makes robust risk management absolutely essential. For algorithmic traders, scalping EAs can be exciting and rewarding, but also unforgiving. They're best suited to traders comfortable with fast action, high frequency, and the discipline required to protect capital in the game of thin margins. Beyond trend following and scalping lie strategies that are more controversial, but still widely used in algorithmic trading: grid trading and martingale systems. Grid trading places buy and sell orders at set intervals above and below the market price, creating a grid of trades. The idea is simple. As price moves back and forth, it triggers orders and captures profits without needing to predict direction. This works well in ranging markets, but becomes risky in strong trends, where unbalanced positions can accumulate. Martingale systems take an even bolder approach. After each losing trade, the system doubles the next position size. The logic is that eventually, one winning trade will cover all prior losses plus generate a profit. While this can work in short streaks, it requires substantial capital and carries the constant risk of a catastrophic blowout if losing streaks run too long. Both methods can be profitable under the right conditions, but demand careful risk controls and large buffers of capital. They are not beginner strategies, but they illustrate how diverse EA approaches can be, ranging from conservative to highly aggressive. With so many strategy types available, how do you decide which one fits you? The answer begins with your risk tolerance. If you're conservative, trend-following systems are generally safer. They focus on larger, steadier moves. If you're aggressive, scalping or grid approaches might appeal, but they require sharper risk management. Next, consider market conditions. Different environments favor different strategies. Trending markets naturally suit trend followers, ranging markets support grid trading, and high volatility sessions often benefit scalpers. Recognizing which conditions your EA is designed for is crucial. Finally, think about implementation complexity. A moving average crossover EA is relatively simple to code, test, and maintain. Grid or martingale systems, on the other hand, require advanced programming, position tracking, and robust error handling. The bottom line, the best strategy is one you fully understand, can implement confidently, and can manage under real market conditions. Complexity alone does not guarantee profitability. Every expert advisor begins with a strategy, and the clearer that strategy, the stronger the EA. Start simple. A trend-following crossover is a perfect first project. Define precise entry and exit rules so the EA executes consistently. Ambiguity leads to coding issues and inconsistent results. Once you're comfortable, you can build complexity gradually. Add filters like RSI confirmations or time of day conditions. Layer in money management rules to control risk. Over time, you'll evolve from simple EAs into more sophisticated systems, but the foundation should always remain strong, tested logic. This lesson has shown how different strategies, trend following, scalping, grid, martingale, each bring unique advantages and risks. Matching them to your personality, risk tolerance, and market environment is the key to developing sustainable automated systems. And that leads us to the next step. Lesson 6, how expert advisors are built. Now that you understand strategy basics, we'll dive into the technical side, the coding structure, event-driven design, and core functions of MQL4 and MQL5 that turn trading ideas into functioning EAs. This is where your strategies begin to take real form in code.